So it's no longer news that Nigeria's central bank on Friday devalued the local currency by about 5.3%. That was on Friday at a currency auction. Since the weekend, a number of reasons had been reported as the basis for the latest action. So Xchange decided to ask the central bank itself for the facts behind the devaluation, and they rode ahead. Joining me live from our Abuja studios is Dr. Hassan Mahmud, the Director of Monetary Policy at the Central Bank. Dr. Mahmud, good evening. It's good to have you on the show this evening. Let's get the show started. So my first question to you is this. Friday's devaluation was the second of such move by the Central Bank in about 4 months. So what are you looking to achieve and why?
Thank you very much, Boason. First and foremost, let me just start on the platform that the Central Bank of Nigeria uses the exchange rate for different purposes. One, while the exchange rate serves as an indicator, it also serves as a channel for the pass-through of monetary policy to the rest of the economy, and it also serves as a monetary policy tool to be used by the Central Bank. So while talking about the exchange rate, it's important to look at this very multiple objective and purposes of exchange rate. It's also a monetary policy target. So looking at what the central bank has always emphasized is to have stability in the exchange rate market. We are not really keen too much about how the direction goes, but what is important is there are no volatility so that investors can make long-term plans. So it's important that we look at the analysis of exchange rate in that perspective. How is the market stable, and how does that rate reflect the demand and supply within the system? So if you look at the terrain now, given the crisis we're in and how that has impacted the supply side of the exchange rate or the external reserve of central bank, you will see that there are a lot of vulnerabilities, there are a lot of constraints coming up from there, and the demand side has not abated. So with the Nigerian economy is a small open economy, as they call it, and because of that, we still have issues at our external account side. And one of the purposes of exchange rate is to also have stability in that external account balance, even though we are looking at the domestic side simultaneously. So it is important that we have some level of flexibility in the market such that the cost of maintaining the stability is not so much borne by the Central Bank of Nigeria. Now, how is that normally done? You have two options. One, it's either you adjust your interest rate to forestall any volatilities coming from the exchange rate, but you know, given the situation we are now, that is not an option. Even from the outcome of our last monetary policy meeting, the central bank actually eased. So it is not an option as on the table now to tighten because we want to adjust that. So the only option for us is to make, the central bank moves against the tides of the exchange rate, such that we are flexible in the direction we go. We are not standing still on a particular side. However, the fundamentals must reflect the rates in the market. So the bottom line is the central bank governor has said it severally, that there's a need, or the central bank is working towards the convergence of those rates. The necessity of having actually those windows or those market segments were just peculiar to the structural problems we have and the supply deficit that we have in the market. So some key sectors were identified by the central bank, which made us to have the SME windows, and then the largest window now is the INE window, which is purely based on demand and supply. So those that have genuine businesses and have genuine transactions to do, go to that window. And there's a lot of liquidity in that market, and there's a lot of transparency in the auctions in those markets. So the convergence of the rate is the ultimate goal of the bank. And that's where the bank is heading towards.
Yes. So, Dr. Mahmoud, how many more devaluations or adjustments should the market expect? And at what point will the central bank decide that such adjustments are enough in the interest of foreign investors, in the interest of the economy, in the interest of multilateral agencies?
Yeah, the exchange rate adjustment, like I said, should be a reflection of the market. It should be a reflection of demand and supply. However, we are also mindful of the fact that some demands are not trade-based. So if they are out of the fundamentals, speculative demands are not what we are driving at. Actually, we want to get the speculative demand out of the system. We want genuine demand that are backed by economic activities, that are backed by trade. If the market drives towards any particular rate, the central bank is supposed to see that that rate is reflecting the fundamental of the market, and it's also reflecting the objective of the central bank, our monetary targets. So it's so that it's not, because you know that there's a very high pass-through, even for most emerging economies, from exchange rate to inflation. And one of the primary mandate of central bank is monetary policy, or is a monetary and price stability. So we are looking at that simultaneously as well as the domestic prices.
So how much of Nigeria's foreign currency shortage at the moment would this devaluation help you to resolve?
Well, I don't want you to be using the word devaluation, because central bank has deliberately not taken any outright, apart from the price adjustment we did from the official rate of 306 to 360, which was also, based on the fundamentals we are seeing. The crisis was coming. There was a deficit in inflows. There are threats, uncertainties of capital outflows. So we really need to, play a role and moderate the market. Our interventions are not necessarily just because we want to fix a rate, but we want to make sure that the market reflects the basic fundamentals and there are no volatilities. I've kept mentioning this. Our priority is that there is stability in the market, so that investments can take long-term plan. So I cannot sit down here and tell you that, okay, we have to be at this rate to be able to. The economic fundamentals determine that. The level of trade determines that. Your total volume of exports determines that. Your balance of payment positions also determines that. And the investors are looking at that. So it's not. We want the invisible hand to play a very high role in that, because it's less expensive and less complex for the bank to have that platform for stability to excel in the market. So I can't just tell you that, okay, we are going down to this rate.
So how do these currency adjustments fit into the broader monetary policy objectives of the central bank under the current pandemic period? You are the director in charge of that department.
Yeah, the current trend regime we have at the foreign exchange market is, a flexible exchange rate regime, and that flexible exchange rate regime means that the central bank only comes in, like I said, drive against the waves. So particularly if the waves are not necessarily reflecting what is going on in the market. But the biggest constraint is the fact that the supply side is really, really inelastic. So it's government inflows, that's the oil received earnings, and all these foreign portfolio investments. And that you cannot determine. Those are factors that are exogenous to the monetary policy and even the Nigerian economy. So the external fundamentals, and I also mentioned that we are a small open economy, which have our balance of payment issues to deal with. The current account position there, it is also very important that we are looking at that, because that is what tells you how the investors appraise your economy and how you are able to build up your external reserve from those inflows. We prefer more of FDIs than the market traders in FX. So the more you have a stable exchange rate regime, the more you have these inflows. And we need these inflows because of the financing deficit that we are seeing. You see the crisis, what is the fiscal authorities have already mentioned the shortfall in financing that we're going to have, because from $57 a barrel we are coming down to 25, and that's a big hole. The fiscal deficit is over 5 trillion. How do you finance that? I don't think you can raise all that money domestically. You need concessionary loans. You need all the private inflows. So for those reasons, and also the domestic price stability objective, we need to, have that robust platform for this demand and supply to play out, and for all these our monetary policy tools to be more effective in addressing our monetary policy targets.
We thank you for your time today on the show, Dr. Hassan Mahmud, Director in charge of Monetary Policy at the Central Bank of Nigeria.